Hi there, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop any comments. Now, let's go for the analysis.
Okay, let's just look at the tape because the numbers on BitMine Immersion Technologies, ticker BMNR, they're screaming a very specific and, frankly, very violent story right now. As of this morning, mid-January 2026, we're trading in a brutal, tight range of about $30 to $32. And the volume is, well, it's absolutely massive. We're seeing approximately 44.3 million shares changing hands daily. Now, if you zoom out, sure, it looks like a disaster. We are looking at an aggressive correction, trading down roughly 80% from the 52-week highs of $161 that we saw during the frenzy last year. But that price action is masking a fundamental reality that I think most of the street is missing.
I'm looking at the same take, but I see a structure that is, well, it's incredibly fragile. You mentioned the $30 range, but look at the technicals. I mean, we just tested a critical support floor at 26.84. That held, yes, but barely. On the upside, we're just slamming into stiff resistance at the 20-day moving average, right around 34.39. But here's a number that actually matters, the anomaly that defines this entire trade right now. The market cap is sitting between $13 and $14 billion. The net asset value, the actually liquid value of their Ethereum holdings, is also roughly $14 billion. The premium has, well, it's completely evaporated. BMNR is trading at parity with its assets.
And that is exactly why I'm taking the position I am today. Trading at NAV parity is a massive, massive asymmetry for the buyer. The market is effectively handing you the entire operating business for free. You're buying $1 of Ethereum for $1, and attached to that dollar is the alchemy of 5% strategy and the upcoming MAVA staking infrastructure. This transforms BMNR from, a passive holding shell into a yield-generating powerhouse. The stock is just fundamentally mispriced relative to the productive capacity of its assets.
Oris, the market is efficient, and that parity is a warning sign, not some kind of discount. I'm arguing that the market is pricing in a severe governance discount. Investors are confused by the pivot to beast industries. They are frankly terrified of the proposal to authorize 50 billion shares, and they see the potential for infinite dilution. You see a bargain. I see a value trap where the equity gets ground down to nothing, even if the underlying assets perform.
I see the fear, I do, but let's strip it back to the business model, because the comparison everyone wants to make is MicroStrategy, and it's just the wrong comparison. You have to look at the sheer scale of the BMNR treasury. I mean, as of January 12th, they hold approximately 4.17 million Ethereum. That is 3.45% of the total global supply. They are 70% of the way to their strategic goal of owning 5% of all Ethereum in existence. That isn't just a position, that's market gravity.
It's a lot of ether, I'll grant you that. But market gravity cuts both ways. When you hold 3.5% of the supply, you aren't just a participant, you are the whale. If you have to liquidate for any reason, you crush your own NAV. Liquidity at that size is really just a myth.
But they aren't liquidating, they are accumulating, and here is the core distinction. Bitcoin, which MicroStrategy holds, is sterile. It sits in a vault, it does nothing until you sell it. Ethereum is a productive asset. It generates yield through staking, and yet, just look at the multiples. MicroStrategy typically trades at a 1.5x to 2.0x premium to its Bitcoin holdings. BMNR is trading at 1.0x. BMNR is fresh money aggressively buying ETH, even in this downturn, and the market treats it like a stagnant closed-end fund.
I'm sorry, I just don't buy that premium argument. The market awards MicroStrategy a premium because it understands the business. It's a singular focus: acquire Bitcoin, issue debt, bought Bitcoin, repeat. BMNR is confusing the narrative. You say they're an Ethereum treasury, but they still have this vestigial holding of 193 Bitcoin. They have a $23 million moonshot position in 8co holdings, and now this Beast Industries deal. It just looks like a total lack of focus. Pure play miners like Mara or Riot, or pure treasuries like MSTR, they have a clean story. BMNR feels like they're just throwing things at the wall to see what sticks.
That's a really superficial read on the portfolio, though. Those vestigial holdings they're negligible compared to the $14 billion ETH stack. It's dust. It's legacy assets from before the pivot. The real story here, the catalyst that I think justifies a premium, is Project Maven. This is the Made in America Validator Network launching this quarter Q1 2026. This is where the physics of the stock change.
Made in America sounds like a bumper sticker. What is the actual utility?
The utility is industrial-scale stapling with regulatory compliance baked right in. They've already staked 1.25 million ETH. Now let's just run the math for the listeners. At a conservative yield of, say, 3.0% to 3.5%, which is pretty standard for the network right now, that generates roughly 37,000 to 43,000 ETH annually. At current prices, that's $110 to $130 million in high-margin recurring revenue. That cash flow fundamentally changes the valuation model. It buffers the downside. MSTR has to sell equity or debt just to pay interest. BMNR generates cash just by existing.
That sounds fantastic in a vacuum, but we don't operate in a vacuum. We operate under the watchful eye of the SEC. You call it high-margin revenue, I call it regulatory bait. The SEC has been incredibly hostile towards staking as a service. If regulators decide that Maven constitutes an unregistered securities offering, that revenue stream vanishes overnight. And then what do you have? You have a company with higher operational expenses and a simple spot ETF trading at parity. The execution risk on Maven is non-zero, and the market is right to discount it until we see it working and legally cleared.
I think you're overweighting the regulatory risk. The entire point of the Made in America branding is to create a compliant domestic layer that institutions can actually trust, unlike all those offshore staking providers. They are building this specifically to court institutional capital that cannot touch Lido or Rocket Pool. It's a feature, not a bug.
Institutional capital hates uncertainty. And right now, BMNR is screaming uncertainty. Let's pivot to the elephant in the room. The thing that I believe is suppressing the premium even more than the SEC. The Beast Industries deal.
Right. I knew we'd get here.
This is where I struggle the most with the bull case. It feels like a fever dream. In January, BMNR announced a $200 million investment into Mr. Beast's corporate entity. That's 20% of their cash reserves. They had $1 billion in cash, and they put a fifth of it into a YouTuber. To me, this just screams diversification. It's thesis drift. I bought this stock for Ethereum exposure, not for a venture capital bet on a content creator. Plus, it introduces cancellation risk. If Jimmy Donaldson has a scandal, that asset becomes toxic.
I'm not convinced by that line of reasoning because you're looking at it as a media investment. You're thinking of it like buying a TV network. Management, specifically Chairman Tom Lee, frames this very differently. This is a customer acquisition cost, a CAC play for DeFi. Mr. Beast has 450 million subscribers. These aren't just viewers. These are Gen Z and Gen Alpha. They are the future financial demographic.
They are kids watching stunt videos. They aren't opening brokerage accounts.
They are the next generation of wallet holders. The goal is to integrate DeFi rails, wallets, payments, savings products, backed by that Maven yield, directly into the Beast ecosystem. I mean, think about the friction of getting a normal person to open a crypto wallet. It's huge. It's terrifying for most people. But if it's integrated into the merchandise or the contests they already know and love, the friction disappears.
That is a massive if. You are betting $200 million on an integration that hasn't even happened yet.
It is ambitious, yes. But think about the leverage. If they convert even 1% of that audience to a BMNR-backed financial product, they rival Coinbase in user count overnight. They are trying to bridge the gap between institutional treasury management and retail consumer finance. It's not a drift, it's a synergy. And frankly, $200 million for access to 500 million users is cheap compared to what traditional banks pay for acquisition.
It sounds great on a slide deck. But let's look at the plumbing, because the flows tell a story of institutions that are very, very cautious about this synergy. I'm looking at the short interest data. It's currently at 6.23% of the float. Now, that doesn't sound astronomically high compared to some meme stocks, but the days to cover is only 0.78.
Which implies high liquidity. It means the market is active. It means people are trading this thing.
It implies shorts are comfortable. They can enter and exit at will without fear of a squeeze. There is no pressure on them. But what's more concerning to me is the dark pool activity. We are seeing nearly 39% of the trading volume happening off exchange. That is unusually high.
It tells me that institutions are hiding their moves. They're actively positioning, likely hedging or distributing without tipping their hand to the lit market. If this was a slam dunk bullish thesis, we'd see more conviction in the open market.
I interpret that dark pool data differently. We know from the filings that institutions like Jane Street and SIG are heavily involved here. These aren't just directional traders, they are arbitrageurs. They're using that dark liquidity to manage the spread between the stock and the underlying ETH. They are playing the parity game. They buy the stock at parity, hedge with ETH futures, and collect the spread. That high dark pool volume is actually a sign of sophisticated market makers keeping the price tethered to NAV.
But look at the options market. Implied volatility is at 93%. That is extremely expensive. It means the market expects a violent move, but it doesn't know which way.
And yet, the put-call ratio is 0.74. That is below 1. It suggests that despite the price drop, more traders are buying calls or selling puts. The sentiment in the derivatives market is actually tilting bullish. They're betting on a rebound.
Or they're selling puts to collect a juicy premium because of the high IV. That's not necessarily bullish conviction, that's just yield farming on volatility. And regarding conviction, let's talk about the people inside the building.
Insider activity.
Exactly. Over the last year, there has been net insider selling. 1.8 million shares sold versus only 1.0 million bought. That is a net negative signal. When the people running the kitchen are leaving the restaurant, I start to worry about the food.
You have to look at who is buying recently. Chairman Tom Lee has been buying via his trust. And frankly, even U.S. Representative Cleo Fields was disclosed trading the stock. Now, I'm not saying we should trade based on Congress, though their track record is suspiciously good, but it suggests the name has broad visibility. The selling you mentioned was largely during the run-up to 161. That's just rational profit-taking. The buying is happening now, near the lows. That is exactly what you want to see insiders doing. Selling into strength and buying into weakness.
Let's move to the mechanics of the stock itself, because there is a sword of Damocles hanging over every single shareholder right now, the 50 billion share authorization.
The proposal to increase authorized shares? Yeah.
Currently, they have 500 million authorized. They want to increase that to 50 billion. That is a 100x increase. It's staggering. It creates a mechanism for practically infinite dilution. If management decides to issue shares below NAV to fund operations or more moonshots, they can dilute existing holders into oblivion. This is a primary reason the stock trades at parity. Who wants to pay a premium when the supply of shares could just explode?
I see the fear, but you have to understand the flywheel. The alchemy of 5% requires capital. They cannot reach 5% of all Ethereum, a scarce asset, without issuing shares. The entire strategy relies on accretive issuance.
Explain that for the listener, because accretive is one of those CEO buzzwords that often hides a lot of pain.
It's simple math. If BMNR trades at a premium, say 1.2x NAV, and they issue a share to buy ETH, the amount of Ethereum backing each existing share actually goes up. They're using the overvalued stock to buy the undervalued asset. As long as they issue shares at a premium to NAV, or as long as the ETH they buy appreciates faster than the dilution, the ETH per share metric goes up.
As long as, that's the risk right there. You're trusting management to be disciplined capital allocators. At the same time, they're asking for a blank check to print 50 billion shares. If the premium doesn't materialize and they issue shares at parity or below just to pay the bills or fund another YouTuber, the shareholder gets crushed.
ETH per share is the only KPI that matters. Management has been crystal clear on this. The 50 billion authorization gives them the flexibility to do stock splits to keep the price accessible for retail and execute this accumulation strategy for years without going back to shareholders for a vote every 6 months. It's not a weapon. It's ammunition for the Treasury. They want to make BMNR a liquid currency that represents ETH.
It's ammunition that can be pointed at the shareholders just as easily as at the market. But let's zoom out to the external factors. Ultimately, you're betting on ETH appreciation. How does the market actually view the probability of that payoff?
This is where it gets really exciting. If we look at the prediction markets, which I find to be a much cleaner signal than analyst notes because people are betting real money, the picture is quite bullish. Kalshi is currently assigning a 52% probability to Ethereum exceeding $4,500 in 2026.
So a coin flip.
A coin flip with a massive upside skew. If ETH hits 4,500, BMNR's NAV rises roughly 45% just on the asset appreciation. But here's the kicker. If the asset appreciates, sentiment shifts. If the stock re-rates from 1.0x NAV to a 1.5x premium, which is conservative compared to MSTR, you are looking at a stock price that could double or even triple. The leverage works both ways. It is a dual-engine compounding machine. You get the asset growth plus the multiple expansion.
But you cannot look at ETH in a vacuum. The entire crypto complex is correlated to Bitcoin. Polymarket shows up, a 49 to 60% chance of Bitcoin breaking 100,000. It's hovering right around 50-50. If Bitcoin fails to break out, or if we get a sell the news event, the entire sector corrects. If BTC drops, BMNR drops, regardless of how much yield Maven generates. The beta is just too high. You're picking up pennies in front of a steamroller if the macro turns against you.
I agree the correlation is there, but BMNR is decoupling. We've seen that in the recent price action, where BMNR actually fell harder than ETH. That means the snapback can be more violent. B. Riley just reiterated a buy rating with a $47 price target. That is 52% upside from where we're sitting today. And that's not some crypto moonboy target. That's a fundamental analyst looking at the sum of the parts and realizing the math is broken at $30.
And investing quantitative models, Investing Pro specifically, flag the stock as overvalued on a cash flow basis. They argue that the NAV floor is the only thing holding it up. If they break that NAV floor because of dilution fears, we could enter price discovery to the downside. So let's wrap this up. I come at it from a different way. I see BMNR as a governance discount play. You have a massive treasury, yes, but it's wrapped in a structure that is terrifying institutional capital. The execution risks of Maven, specifically the regulatory aspect, the diversification into beast industries, and the threat of the 50 billion share authorization just make this too risky for prudent capital. You're paying parity because the market simply doesn't trust the pilot.
And I'm saying the pilot has built a machine that is just about to turn on. BMNR is a coiled spring. It is a productive, yield-generating Ethereum treasury trading at the price of raw assets. You are getting the business for free. The downside is buffered by that $14 billion balance sheet, while the upside relies on a triple whammy: ETH appreciation, staking yield for Maviane, and multiple expansion once the market finally understands the beast strategy.
It all comes down to execution.
We agree on that. The January 15th shareholder vote on the shares and the Q1 Maviane launch, those are the binary events.
Those are the moments where the rubber meets the road. Until then, the market waits.
And that is where we have to leave it for today. This is The Debate.
If you like this video and want to watch more content like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching. See ya.